Joining me now is Apollo Global Management Chief Economist Torsten Slok. It's great to have you back on, this time from Apollo. Torsten, welcome.
Thanks for having me, Sarah.
So even though Bostic says it doesn't do much for him, the market is taking it as a sign that the Fed won't have to do all that much more, or may be able to pause sooner than expected. The slower wage growth, the weaker services, is that the right take?
Yeah, I mean, both what Mike is saying and also what Bostic is saying here, I mean, this is the definition of a soft landing. I mean, we have inflation coming down. The economy is not slowing dramatically. It's gradual, it's steady, as Bostic just said. And all that tells you that up to this point, this recession that we all have worried so much about for so long is not really showing up in the data. There is definitely recessionary tendencies in markets. But in the real economy, it is the case that inflation is coming down, as the Fed has been trying to achieve for quite some time now. And at the same time, the labor market is still holding up. And that's definitely good news from a bullish perspective.
No, I mean, as far as the report is concerned, it really does speak to a soft landing. You got the hiring and then the moderating wage growth. On the inflation side, the problem, Torsten, is that the Fed is not going to be satisfied. They are resiliently sticking to their 2% inflation target and their tough talk against inflation. So the risk for the market is that they way overdo it, isn't it?
Totally understood. I mean, the only issue here is that, as Jay Powell has said, and as several FOMC members have said more recently, they will continue to go at it. And here is the quote: until inflation is well underway towards the 2% target. What does well underway mean? If you look at the consensus, by the middle of this year, the consensus expects that inflation will be at 4%. And by the end of this year, the consensus expects inflation will be at 3%. Is that well underway? Is that enough for the Fed to begin to take a break? At least the market pricing, if you look at the OIS curve, is expecting that the Fed will peak with the Fed funds rate at 5% by the middle of this year. So that means from a trading perspective, we are only really 4 or 5 months away from the Fed beginning to pause. And the consequence of that, of course, is that the Fed will certainly stay very, very attentive to all the details, both on the inflation front and also, of course, on the labor market. But so far today, with average hourly earnings falling in December to 4.6 from 5.1 in November, that's a steady decline in wages. So if that trend continues, and with CPI next week also trending lower, that does certainly tell you that the Fed is succeeding in getting inflation down towards and being well underway towards the 2% target.
Talking the slowdown in the economy, Torsten. So I guess what I'm wondering, you expect the Fed to pause along with the market's expectations in the middle of this year. Are you guys as a firm at Apollo, is your position that you are then bullish overall, that will cause a rally and the soft landing scenario to play out?
Well, I mean, the scenario, of course, that the market has priced in is certainly a soft landing. The consensus does not expect a deep recession, and the consensus also is telling you that earnings should not be slowing down dramatically. So from an investing perspective, I mean, this just speaks to the fact that markets have been a bit more wobbly because we just don't know quite yet how quickly inflation will come down. But if inflation is coming down a little bit faster than the market has been expecting, and if the narrative here in the beginning of 2023 is that, well, now we know that inflation has peaked, and now we also have a discussion about how quickly inflation will come down, that's very different from the narrative we had last year, where it was all about how much is inflation going to go up, when will the Fed be done with all these rate hikes. That now we have much more clarity in terms of the outlook, and that should be, and is, particularly of course today, something that generally should be good both for credit and for equities and for risky assets.
Yeah, well, let's just see if the Fed buys it. We haven't quite heard that pivot in tone from them yet. Thank you very much, Torsten. Appreciate you joining me.